So I will send that out with some handouts that are available when you logged in. So if you miss anything today or something comes up and you have to jump off, don't worry, we will get the recording out to you just as soon as we can so that you can follow up on any questions or information that you might have missed. I would like to take just a moment for our mortgage team to say hello and introduce themselves. So if Kristen, if you want to go ahead and get started and tell us a little bit about what you do here and say hello to the group.
Hi, everybody. My name is Kristen Riley. I am one of the mortgage originators. So I am the person that kind of helps with the loan process. So I'm the one who will actually help you with the application and help you throughout the application process. And, you know, after we really get that going, I'm your main point of contact when it comes to your loan process.
Thanks, Kristen. We also have another member of our team. Shelby, do you want to say hello?
Hi, I'm Shelby Wagner. I am also a originator, and I do the same thing that Kristen does. So if you don't work with her, you'll be working with me throughout the process. And as always, if you guys have any questions, you can always reach out to either one of us, and we'd be happy to get you the answer.
Thank you. And we have Laura as part of our mortgage team as well. Laura, do you want to just say a quick hello and let folks know what you do here?
My name is Laura Humphreys. I am the mortgage operations manager, and I actually review all the loans. So I just look at the loans up front, and we try to, figure out if it's within the guidelines up front, so you don't get to the end of the process and we end up declining your loan at the end versus at the beginning, if it is going to be a denial. So we do take a look at all of that stuff up front. So that's me.
Great. So we've got some very knowledgeable folks on the call here today who are going to be able to answer any questions that you have. Go ahead, as I mentioned, and put those in the Q&A as we move along if you have any questions. If we're unable to answer them as we go along, we will have a couple of moments at the end to wrap up and make sure that we get all of the answers to those questions for you. Let's go ahead and get started with what we want to cover today. We're going to talk about home equity loans. And we are going to cover the basics, what is a home equity loan and how do you calculate your equity, which can be very important if you're figuring out how much you might be able to borrow. We're also going to look at the differences between the two types of loans, which are lines of credit that are something that you can use and pay back as you go, or something like a loan that's more of a fixed term. So we'll go into all of the comparisons of those, and you can determine what might be best for you. We'll take a look at loan qualification, so what you need in order to get a home equity loan or line of credit. And then we'll also take a look at the loan process so that you know what you'll be looking at in terms of from the time you file your application to the time that you actually get your funds. Let's get started by breaking down what a home equity loan is. To start, we're going to talk about what is equity, a very important part of this calculation. Basically, equity is the amount of value of your home that you own. Most people take out a mortgage in order to buy their home because it's such a large investment. And what that does is actually gives the lender interest in a part of their home. So the lender has a legal right to a certain dollar amount of that home if for some reason you're unable to continue making your payments. So what your equity is the value of your home that's not covered by that mortgage. Let's break this down a little bit more so you can see an example. So I've got my house here. The value of my house is $150,000. I had to take out a mortgage to buy the property, and right now my mortgage balance is $85,000. To calculate my equity, I take the value and subtract the amount of the claim against the property, which is my mortgage, and I get $65,000. So right now in this example, I have $65,000 worth of equity. When I take out a home equity, I'm leveraging the amount of the home that I own, and I'm giving up some of my equity in exchange for that loan or that line of credit. You may have heard a home equity loan called a second mortgage. And a lot of people think that's because you usually take that out after the first mortgage. So that's why we would call it the second. That's true. Most people do take out their home equity loans after they take out the loan that helped them buy their house. But it's actually a little bit more about who has claim to the property if for some reason the borrower is unable to continue to make their payments. So the person who helped you finance the home, the first mortgagee, they're going to have the first claim to the value of the property if the borrower is unable to continue to pay. So that's why they're called the first mortgagee, or they're in the first mortgage position is another way to say that. When you take out your home equity loan or line of credit, that person is in line to get additional amounts if you do not pay the loan, but the first mortgagee will have the amount that they are owed come out first. So they are what's called in second position, and that is why it's often called a second mortgage, in case that's helpful for everybody. So it's important to know that when you do a home equity loan or a line of credit, you are giving that lender a claim to your property. You are giving up some of your equity, but there are a lot of benefits that you get in exchange for that arrangement. If you take a look at this graphic here, you can see kind of how the equity would break up for somebody with a home equity loan or a line of credit. So we've got our first mortgagee owning generally a larger stake of the house. The home equity loan accounts for a smaller stake, and then the homeowner still owns some of their own equity as well. So that's kind of how those three all come together. An important part of your home equity loan or line of credit is what's called your loan to value ratio. That is going to be how you determine the amount that you can borrow. Let's do an example for this, and we're going to do some easy math. That's the kind of math I like to do. So I have a property value of $100,000. For this particular loan, I can go up to 95% of that home's value. So my loan to value is 95%. I multiply that by 100,000 and I get $95,000. In order to determine how much I can borrow, I need to take 95% of the property value, or $95,000, and then subtract the first mortgage balance. For this example, we're going to use $60,000. That makes my potential loan amount $35,000. And so this is something that you can do to calculate your own loan to value ratio if you want to know about how much you can borrow. But of course, our mortgage originators are also always able to help you do that as well. Let's take a look at some potential loan amounts when we take a look at different loan to values. So depending on how much of the value of your home you want to borrow, that can affect your interest rate. So we have a couple different categories, and we'll break it down so you can see potential loan amounts. So we have 80% loan to value in our example that we talked about. That would give you $20,000. We have 90% loan to value, and that would give you $30,000. And if you went to the maximum that the credit union allows, 95%, that gives you $35,000. Now, many lenders are only able or willing to lend up to 85% loan to value. But with OUCU, you can unlock more of your home's equity because we lend up to 95%. So in this example, if you take a look at the difference, that could be an additional $15,000, which could be a new kitchen or a small car. So you can really see how working with OUCU allows you to get more out of your home's equity and helps you reach those goals a little bit faster. Now that we understand the basics of what equity is, and we've talked a little bit about loan to value, let's take a look at some of the differences between a loan versus a line of credit. So you can start to get an idea of which one maybe would work best for you. Okay, so on our loan versus line of credit, let's start by looking at the interest rate. We have a fixed interest rate on our loan. So that means whatever you have as your interest rate on the day that you sign those papers, that's going to be your interest rate through the life of the loan. For our line of credit, That's going to be a variable rate, which means it can change. It can go up or it can go down. I think if someone's going to have a variable interest rate, it can be sometimes a little confusing because they don't exactly know how it's going to work. So I want to take just a moment to explain how our variable lines of credit work here at the credit union, so that you have a little bit of idea of how that rate might change. With a variable line of credit, you're going to be looking at two factors as to how your loan interest rate can change. So you've got what's called the index, and that is a broader market condition. So for this one, we use the prime rate, which is published in the Wall Street Journal quarterly. So we take our index, and then we either add or subtract a percentage. And that amount that you add or subtract is called your margin. So those two factors are always going to be in play for your variable lines of credit. Your index, which for us is the prime rate, can go up or can go down. Your margin is always going to be the same. So we're always either going to add or subtract a certain percentage from that prime rate. For our best interest rate, right now it's 2.75. That's on a line of credit, so it's variable. And how we calculate that is we take the prime rate, which is 3.25, and then we subtract 0.5%. So if the prime rate changes, your loan rate will change as well, but it will always be prime minus 0.5%. And hopefully that gives you a little bit of an idea about how those variable interest rates are calculated and can make that a little bit less confusing. The next difference that we want to cover on the loan versus the line of credit is our payment. So if we have a loan, we have a set payment, and you pay that amount every month until the loan is paid off. That's different than our line of credit, which is based on your usage. So most of us have probably had experience with a credit card where maybe we use it a little bit more one month, we use it a little bit less one month, and the minimum balance or the amount that we have to pay changes. So your line of credit is going to work really similar to that. The amount that you use is going to impact your payment. So if you use a little bit more one month, your payment might be higher. If you use a little bit less and pay it down, your payment is going to be lower. The last difference that we want to talk about is how you're going to get the funds from the loan or the line of credit. The access to funds for a loan is as a lump sum. So that's why a lot of people use this type of arrangement for consolidating debt. So they need all of the money at one time, and they want to just start paying it back. The loan is also really helpful for a home improvement project that's really you're going to need all of the money in a pretty short period of time. Because once you take out the loan and you get all of those funds, you're going to start paying interest on that total amount. With the line of credit, it's a little different. So for the line of credit, you're only going to use what you need, and you're only going to pay interest on the amount that you're using. So line of credit is often good for somebody who has multiple projects that they want to work on over a longer period of time, or maybe they're looking for some backup emergency funds, and then they're not having to pay for any funds that they're not using. So those are really the three main differences between the loan and the line of credit. So that is your interest rate, your payment, and then how you access those funds. I'm sure a lot of you have some pretty good ideas of what you might want to do with your home equity, but if you're thinking, what are some ways that I might use this, especially to improve the value of my property, I've got some information that I just want to share with you here. So if we're looking at home improvement, it's really the most popular reason that people take out a home equity loan or a line of credit. Let's just take a look at some projects that can boost your value. So the first one we have is a minor bathroom remodel. That means replace your tub, your floor, your toilet, your sink, your vanity, and your fixtures. So doing those types of minor remodels is actually going to be one of the better investments in terms of the money that you spend getting that back in the value of your home. Landscaping can also be a project that boosts your value, especially if you're adding a focal point like a flagstone walkway or a fountain. And you can get ideas for what might work for your property by consulting with a garden center. A minor kitchen remodel is also a wise investment to boost the value of your home, but that's including really more like cosmetic updates to cabinets, counters, and flooring. Doing a major change to the floor plan actually won't pay off as well. That's not to say if you really dislike the way that your kitchen is laid out that you shouldn't just change that because it's going to make your experience of living in your home better. That's perfectly fine as well. But if you're looking for a project that's going to be more of an investment, they actually recommend more of a minor kitchen remodel than a major overhaul that changes the floor plan. Exterior improvements, like replacing vinyl siding or a new coat of paint, maybe replacing a wrought iron railing with wood or adding columns or a pergola to that front step is another way that you can improve the value and get a good investment for the home equity dollars that you spend. And lastly, adding some outdoor living space. Maybe a deck, a patio, or a porch addition can increase your value as well. Then you can brighten it up with some decorative planters or some eye-catching plant varieties. Again, your garden center is a great place to consult for that. Probably the second most common use of a home equity loan or line of credit is debt consolidation. Let's take a look at how much money a borrower could save if they needed to consolidate $25,000 worth of debt. So I've laid out 4 different credit cards here that we might want to consolidate. The total balance is going to be $25,000, and there's different interest rates ranging from as low as 11.5% to as high as 23% interest. The monthly payment for all of these cards is $750, and that's paying 3% of the balance. If the borrower goes ahead and just pays these cards off, continuing to make monthly payments of 3% of the balance, their total finance charge is going to be $20,300. And there's also going to be up to 266 months for them to pay that off if you look at card number 2. So what happens if we consolidate this debt and we use a home equity loan? The home equity loan that I've chosen for this borrower is an 80% loan to value, and the interest rate right now would be 3.99%. So they're going to consolidate the $25,000, and their monthly payment on that loan is going to be $342. They're going to pay an estimated about $3,600 in finance charges to pay that off, and they'll do so in 84 months. So if we compare that to what would happen if they just paid on those credit cards, they're going to save $408 a month on payments. They're going to pay their debt off 105 months sooner, and they'll save $16,000 on total finance charges. And that is quite a bit of money there, a large chunk of change to be saving. So hopefully that can help you see a little bit about how this might work for debt consolidation. Another very common reason that people will take out home equity, generally a line of credit in this case, is to have a little bit of a backup for unexpected expenses. So our financial experts recommend that we have between 3 to 8 months worth of essential living expenses in our emergency fund. If someone has essential living expenses of $1,500, that could be between $4,500 to $12,000. So if you're like me, you're thinking, wow, $12,000 is quite a lot for me to get saved up. And for some, that number just might seem unachievable. Some individuals would prefer to supplement their emergency account with access to a low-cost line of credit, like a home equity line of credit. And that can reduce their reliance on higher rate credit cards. That's not to say that we shouldn't have some cash set aside in our emergency fund. That's definitely a good idea. But if it's going to be difficult to achieve that total amount that you want to really have that peace of mind, then considering a low-cost line of credit like home equity can be a really good option for you. Probably the best part about these loans or lines of credit is that you really get to decide how you want to use it. A lot of people use it for educational expenses. Maybe they need recreational equipment or they have recreational expenses that they want to cover. Or they might even use it as a down payment for financing on an investment property. Really, it's up to you and your goals about how you want to use your equity. Now that we have a little bit more information about what our home equity is, how we might use it, let's take a look at what it takes to get a home equity loan or a line of credit. The first thing is you need to own your home. So home ownership is a primary way that you can qualify for this type of loan. And the home that you're going to have the loan on needs to be your primary residence. We cannot do a home equity loan or line of credit on a rental or investment property. You also have to have available equity. Our minimum credit limit for a loan or a line of credit is $10,000, and the maximum loan to value is 95%. So if you go back to that loan to value calculation, you're looking at having at least $10,000 worth of equity that you can exchange at 95% loan to value. Probably not a surprise, your credit history and credit score are going to be a part of your loan qualification. However, there is no minimum score for our home equity loans, and we do local underwriting. So you all heard from Laura at the beginning of the presentation here, and she let you know that she's actually somebody that's going to take a look at the loan that you submit, and we're going to try and look at the whole borrower. We're going to try and find something that works for that individual. So for somebody that's sitting here today that's a little concerned about their credit history or their credit score, definitely give us a call or give us a chat and email, and let's talk about it. Let's find out where you really are and what we can do to help you get either where you want to be, or if we can work with the current credit situation and still get you what you need. So never let that stop a conversation. And the last thing that we're going to talk about for qualifications is our debt to income ratio. And that is how we're going to decide whether or not a borrower is going to be able to pay back their loan. So it doesn't work for anybody to have someone in a loan that they can't pay back. And that's why we use this debt to income ratio as a guide. Basically what it is we're going to take all of your monthly obligations or payments and compare that to your income and get a percentage. So for those payments, what we would include is your current mortgage loan, your property tax, and your homeowner's insurance. We would do those as a monthly number. And then other loans like credit card payments, auto loans, student loans, whatever you've got going on there. We'll compare that to the monthly income and we'll get a percentage so that we know that we're in a good range for you to be able to make those payments and be successful with your loan. Great, guys. The last section that we want to cover is our loan process. We make it pretty easy for you to take out a home equity loan or a line of credit. However, it is not quite as simple as applying for a credit card or an auto loan. So you are exchanging some ownership of your property. So there are some different steps that we need to go through in order to make sure that everything gets taken care of for that process to work out legally for both sides of the equation. And let's take a look at what those are. We're going to get started with an application. So we're going to collect personal information, including employment, income, and credit details. The information that you provide on that application will be supported by additional documents. So that for our home equity loan is going to be 30 days worth of pay stubs. It's going to be your current mortgage statement, a copy of your deed, and a copy of your homeowner's insurance declaration page. So right now we're in a different environment. I guess that's one way to say it. So our mortgage originators are working from home primarily, and we're doing our applications online or by phone. So you can come in and get a paper application if you wish, but we're encouraging folks to use that online option or to call us by phone, and we can go over that with your mortgage originator. So as we collect that personal information, we're also going to want to collect some supporting documents. Having all of those available at the time you make your application can make it just a little bit easier and quicker for you. So since we're not doing quite as much in person right now, there's some different ways that you can get us those supporting documents. You can upload those to your online application, have a secure email service that you can send those through, or we can always do an in-person drop-off. And if you do that, we do actually ask that you send us copies just so that we don't have those originals and you can keep those safely. After we collect our personal information and our supporting documents, we will have some disclosures for you so that you can understand the loan that you're working on and make sure that you understand all of the details about what will be involved in completing that. And electronic signing is available for those, just to make it even easier for you in today's environment. Once we go through our application process, that's when we're going to send the application to review. Somebody, a human, probably Laura, is going to take a look at that and decide how we can help that individual borrower with that application. After the application is reviewed, if everything looks good, we'll go ahead and offer pre-approval. So your pre-approval is generally going to take about 2 business days. It's based on income, credit, and your estimated home value. So we're going to get to exactly how we determine that estimated home value in just a moment. So some folks have had an appraisal for their first mortgage, and that might be a way that they can get an idea of where their home might be at. Some folks can take a look at some other homes on the market and what they're selling for in terms of determining how their home may be valued. You can also look at your tax card. The tax value is generally lower than the market value. Of course, your appraiser is going to make the final determination on it, but those are some different ways that you can start to get an idea of what your value may be at, so you can calculate that loan to value and kind of know where you stand. But after your application is pre-approved, the next thing we're going to do is we are going to order an appraisal for you. So that appraisal is going to be the determination of the value of the home based on today's current market. It's a very important step that OUCU will request through a third-party appraisal vendor. So neither us at the credit union nor you as the borrower get to choose who does the appraisal, because it really needs to be an unbiased assessment of the property's value, and we want to remove all undue influence, and that's why this is handled by an outside company. The appraisal will schedule an appointment with the homeowner, and they'll see the inside and the outside of the property. Now, sometimes our borrowers say, the appraiser wasn't here very long. I'm concerned that he didn't get a good idea of what my home is worth. These appraisers are professionals and they do this all the time, so they actually can do it pretty quickly, and they can learn a lot from that tour of the inside and outside of your home. They're going to determine the value of the home based on the current market conditions, and they're going to look at the sale of similar properties to determine what your home is comparable to in the market. After they make that determination, they are going to send that to our underwriters who are going to review it, make sure that that appraisal is complete and contains all of the information that we need. After it's been reviewed by the underwriter, it will be sent to your mortgage originator, who will then provide it to you. We do have some folks asking us, are you going to send this to the county auditor, especially if it's higher than the tax value that they have on their card right now? And no, we do not provide it to the county auditor. It is just between you and your lender, which is us, our mortgage originator. If the value is different than we assumed when we started the process, then we can take a look at some adjustments based on that final value if we need to adjust the loan to value calculation. And so we did have a question come in through the chat. Can you use the appraisal sent to you by the tax assessor? If you can hold on for me 1 second, we're going to get one of our mortgage originators to answer that one for you so that you make sure that we get the right details on there, okay? All right, so while we're waiting on an answer for that, let's keep going on our loan process, and let's talk about the next step, which is the title search. The title search is the last step before we get ready to close the loan. So effectively, what you're doing here with your home equity loan is you're exchanging your equity as collateral on the loan. So this title search is very important because it's going to help us determine whether there are other claims against the property. So is the value that we've seen in the appraisal really there, or are there other liens or mortgages against the property that would not allow us to make that exchange? We're also going to look to see if there are other claims that the borrower has and anything that might interfere with that exchange of equity. So that's what we're going to do with the title search. Some of the things that may come up that might be an interference are mortgages that haven't been properly released. If there is an improvement that wasn't paid for, there might be something like a mechanic's lien filed, outstanding property taxes, or unpaid debt from a borrower that's generally called a civil judgment, where the borrower has been ordered to repay a debt by the court, but they haven't actually completed that yet. The title search is a really important part of this process. It protects us as a credit union. It also protects you. So it gives you that peace of mind so that you know that the equity that you think you have in the home is really yours. The title search is time sensitive. When we get to the title search process, after that's completed, we're going to want to finalize that loan by signing the documents generally in about 1 week. And that brings us to our closing. So closing is done in person at the credit union, and this is where it all comes together. Your mortgage originator will explain each of the documents that you need to sign so that you understand the details. If you are married, your spouse will need to sign on the document, even if they're not on the loan, because in Ohio, they have rights to the property as a result of the marriage. When you come to closing, be sure that you bring your driver's license, and you will get a copy of everything that you signed to take with you. After you close, you then enter the right to rescission period. So this is 3 business days after closing. And it gives you the option to decide, hey, wait, I didn't want to do this. I want to cancel my loan. This right to rescission period is a federal regulation. It cannot be waived. We sometimes have folks say, I know I want to do this. I don't want that 3-day right to rescission. But unfortunately, per regulation, we still have to wait that 3 days before we're able to fund the loan. The reason is this is a really big decision, and the government wants to make sure you are not getting any undue pressure from us as the lender to sign these documents. Now, of course, that's why you choose the credit union, because you're not going to get that pressure, but this is part of a regulation that we will follow when you complete your loan. So after the 3 business days, the funds will then be distributed as you've arranged with your mortgage originator. Let's take a look at some ways. If you're consolidating, then the credit union will process those payoffs or the credit closures, if you're closing those lines as a result of the consolidation, either upon your request. So you say, will you handle these checks for me? I don't want to deal with it. Or sometimes that's a condition of the loan that we process that on your behalf. For line of credit, you have several different options about how you're going to access those funds. Remember when we talked about the line of credit versus the loan, this is the thing that you can kind of use as you need it. So you can get a book of checks by request that doesn't cost you anything, and that's going to automatically debit the amount you spend on those checks from that line of credit. You can request that a cashier's check be created at funding, or you can come into the branch or give us a call or go through the drive-thru right now and get a cashier's check at any time. So that's great if you've got a large payment to maybe a contractor, or you want to have the ability to provide those details and have a trace of that, because you'll get a little stub that has some details with it for you. You can also make it super easy to access your line of credit by just transferring those funds to an OUCU account, like a checking account. So you can do that transfer online, by phone, or in person. And most people, realistically, they really do prefer that transfer option because they don't want to have another checkbook that they have to manage and keep a hold of. So that is what a lot of people do. But of course, we've got lots of different options for you. As we discussed with your loan, all of those proceeds are going to be available at the time of funding. and that can be deposited to an OUCU account or be sent as a cashier, or you could pick that up as a cashier's check. That's up to you and your mortgage originator. We'll talk with you about that process and how you want to receive those funds. Okay, guys. So we are now to almost the end of our presentation, and we're going to talk a little bit about repayment. So now you've got the money from your loan. How are you going to pay it back? So for our due dates, the loans are always going to be due on the 1st of the month. Your line of credit, the due date is going to be the 20th. You unfortunately cannot change those due dates. So if you've worked with us for things like auto loans, you may be able to, pick your due date on those particular types. But on the home equities, the loan's always due on the 1st. Line of credit's always due on the 20th. Oh, apologies on that. There we go. When we have the loan, remember that's a fixed payment. It's going to be based on the rate and the term, so that's not going to change over the life of your loan. Your variable line of credit is going to be based on the amount you use and how long you've got left to pay that back. Now we're going to take just a moment to hear from Kristen, and she's going to tell us a little bit more about why you may consider choosing OUCU for your home equity loan or line of credit.
Hello again, everybody. So why choose OUCU? We do have a really easy application process. It's not super intense. I like to tell people during the loan process with us, a lot of your work actually happens up front. We ask for a lot of those things right in the beginning. And then from there, we're kind of smooth sailing. It's a lot of just kind of communication back and forth, but nothing too intense. So a lot of the work really does happen up front. So it's a nice and easy application process. We do have competitive rates and terms. We can lend up to 95% loan to value. Not all lenders will actually go that high, which is kind of awesome. So we do really help you maximize on the equity in your property. We do offer convenient payments through online banking. We do automatic payments. So we have a lot of ways to make this nice and easy for you even after the loan has been finalized. And something else that I always like to mention too when it comes to the home equity process or really any loan with our team, if you're going to do any mortgage product with the credit union, we do maintain all servicing rights. So you're going to be dealing with us from beginning to the very end. So no matter what your questions are, no matter what happens throughout the process, if you guys, 4 years later come back to us and you're like, think about doing something totally different, your loan's going to be here. We can answer any questions about it. We're right here in Athens. You know how to find us. We were also just a call or email away if you're not here locally, but it's going to stay with us. And so that's a nice little peace of mind to have. And we are the top mortgage lender in Athens County. So just a little bit of bragging rights right there. But also I think that speaks to how much people truly do trust us. People are coming to us for a reason. They know that they can trust us when it comes to their home loan. So, like Eva said, if you have any questions, let us know. And when it comes to home equities, sometimes home equities might not be the answer for you. Feel free to call us if you have questions. We're more than happy to walk through and say, maybe a cash out refinance makes more sense, or absolutely, let's look at a home equity. But given your current situation and the fact that you might be doing projects over time, a line of credit might make more sense. So don't hesitate to call us. We're a wonderfully friendly team. We're more than happy to do anything that we can to help. And I'll pass it back off to Eva with that.
All right. Thanks so much, Kristen. And you might be saying, yes, I'd like to give you a call. And so here's the information that'll let you do that. So you can give either Shelby or Kristen a call. You can give them an email, whatever works best for you, and get those questions out there. I know that we've gone over a lot of information today, but a lot of this really is just tailored to your own personal situation. So it's great to come armed with the knowledge that we discussed today, and then to apply that to your own personal situation. And Shelby and Kristen can really help you do that. So if we have any questions, we can go ahead and look at those now. I'm going to just take a look at our Q&A, make sure that we got all of those answered. And I am still working on that question from the beginning here of the presentation, so I haven't forgotten about you. All right. I think we've gotten all of our questions in the Q&A answered, working on that one that's in the chat still, and we'll get an answer for you for that one. So do we have anyone else who has a question for us today?